Jak się inwestuje na świecie? Dyskusję poprowadzi Paweł Borys, prezes Polskiego Funduszu Rozwoju, którego serdecznie zapraszam na scenę. Witamy ponownie, panie prezesie. And now, let me invite our experts. Esther Varudi, Senior Portfolio Manager in Active Fundamental Equity, Managing Director at State Street Global Advisors. Please join us. Welcome. Simona Gambarini, Senior Market Strategist, Executive Director at Goldman Sachs Asset Management. Welcome. Our next guest is Jose Mazoy, Global Chief Investment Officer, Santander Asset Management. Morning. And Chris Pierce, Managing Director, CEIC. Please join us. And I would like to invite Zbigniew Wójtowicz, CEO, Investors TFI SA. And the floor is yours.
Hello. Welcome. We have today very distinguished speakers, so warm welcome on the forum. We'll try to warm you up a little bit after the lunch. We will split the panel in two parts. In the first part, I will ask you some brief questions, and please, for brief answer, yes, no, with some short rationale. We'll try to create some assumptions for the general macro scenario for the next decade, so the question will be very easy. In the second part, we'll try to deep dive a little bit, and I will ask more broader questions dedicated to the speaker. So, first question is on the technology, because in the last decade, we observe a lot of new innovations. We have cloud computing, deep learning. For many years, we are talking about AI, but for the long time, this technology was not so popular as it's become in the last few months with OpenAI and ChatGPT. And the first question to all of you, and please answer in the alphabetical order, so from my left, from Easter, whether do you believe that AI will just start the next industrial technological revolution, or will be another technology which will not result in significant boost of productivity, changes in the labor market, and in the whole economy? What's your view?
Can I take this one? Is it on? Right. It's an easy question. No, the way I look at AI is as a tool. It just helps you do things. And I think that as you look out into the next decade or more, you see several drivers that are going to shape the global economy. One of them is climate, but with electrification of the economy. And once you electrify and you go to smart grids, you're going to need AI. And then another thing is defense. Defense is moving more into cyber, more into space. Again, you're going to need AI to drive some of the technologies. So I think that AI is there, but you will need humans to actually decide what it's going to do.
Yes, so you mean application, but yes or not? It will be the next industrial revolution, or?
I think we've already started. I think IT is a huge driver. And, we love IT. But I don't mean when I say that Facebook or whatever, I mean real IT, semiconductor, hardware, that kind of IT. Yeah? Well, that is booming, and it's going to keep on booming.
Thank you.
So I would say, if not the biggest shift since the Industrial Revolution, it certainly will be, AI will be the biggest shift since the cloud, since the internet, since mobile technology. So we think it will actually disrupt a lot of different sectors. From an economic point of view, we estimate that it will boost actually GDP growth by about $7 trillion over a 10-year period, and productivity will be boosted by 1.5 percentage points, which is massive. As we discussed before, we were talking about declining demographics. This can really make the difference and offset some of those forces. From an investment point of view, there are three areas really that we look favorably at the moment. The first one is really those companies that use generative AI to make their business more efficient. Companies then that use predictive AI to make their business smarter. And then all those companies that manufacture the hardware that will make broad-based adoption possible. And so how Hester was talking about cybersecurity is one area that we look very favorably. Healthcare is another area that we look favorably, and semiconductors as well. So big changes ahead.
Okay, thank you very much. And
Well,
Jose?
so very quickly, we do think that basically AI is going to be something that will create the next industrial revolution, if you want. The timing is a little bit uncertain, but what is not uncertain is the amount of investment that is going to go into this sector, right? Only a couple of weeks ago, Rishi Sunak, for example, from Great Britain, said that they want to become the AI capital of the world, right? Which requires a great amount of investment, mainly in two fields, in the computing field and in the data field, right? In the computing field, in order for you to be able to train these models, basically you need a lot of computing power, and basically the chips that require that computing power are not available at the moment in the UK, right? As they are, for example, in the case of the US and so on. So we're already seeing like a big supply constraint in terms of semiconductors, and that type of investment is still going to be coming up, right? And from the data point of view, in healthcare, for example, we think that this is going to unveil a lot of new opportunities, which we don't know at the moment. Whether we would get to a super intelligent entity, right?
Asset manager.
Yeah, so we don't know when it's going to happen, but it would certainly happen, right? But that is besides the point. I think it's the investment what matters, right?
Okay, thank you. Chris?
I think the answer is probably no, and not on its own.
If you could take the microphone.
Yes, sorry. Okay. You know, I think AI and generative AI, ChatGPT, etc., you know, is a wonderful technology. It is going to create a huge shift. It will transform the way that we work. It may even replace some jobs as well. But will it drive a kind of a period of sustained growth? I think it will support that, but I don't think it would do it on its own. And I think if you look back at history, you know, technology has automated great swathes of agriculture, of manufacturing, but that's often led to us then spending more time and money in non-productive areas of the economy, or less productive areas of the economy, such as education and leisure, and so forth. And when you look back to the 1700s and the kind of first industrial revolution, it wasn't just the Jenny wars. There were lots of other things coming together that would need to come together to support that as well. So at that time, it was about improving property rights. It was about the adoption of the scientific ethos. You know, I think for AI to be successful, there are other things that need to come alongside that. Regulation might be one area to support that growth.
Okay, thank you.
So, my first idea was to pose this question to ChatGPT during the next coffee break, but I can do it now. So I would say that I'm not a specialist in the AI area, but I have an impression that we have just entered this new path, and there's still more questions than answers. And I assume that this shift will happen somehow in the next years. And one more remark, maybe. and that's interesting to me, that those who are deeply involved, entrepreneurs and scientists, they do not only, especially entrepreneurs, they do not only promote this invention, but they also warn us that the several negative consequences may appear. So it's not typical that somebody who has invented something and want to sell it and want to, let's say, build new companies, and on that they say at the same time that there are many worries about how the result will be in the end.
Okay, so thank you very much. So I believe that we all agree that AI will actually bring, or already started, the major technological revolution, and will be an important driver of investment, and will be investment topic also in the financial industry. And from the macroeconomic standpoint, it should increase productivity in the long term, which of course is positive, especially in this inflationary environment. So second big topic, globalization. In the last few years, we have trade wars, we have major geopolitical tensions, and clearly the globalization stalled. We don't know whether for permanently or for some time. So the question to you, what you believe, whether this is the end of globalization, just the slowdown and we'll come back, or we are heading to world which is more fragmented, and we again are recreating some trade blocks.
Is this on? Okay. For me, anything critical that can be used for military purposes will be reshored. There will not be very sophisticated semiconductors made outside of the US, for example. And that's what the CHIPS Act is all about. So, I mean, if it's toys, if it's plastic, whatever, I don't think anybody cares. But if it's something really critical to the military and the defense of the country, it's going to be reshored. That's the way I'm looking at it.
Okay, Simona?
I would say that certainly globalization has been put to the test in recent years. But more than deglobalization, I think we are heading towards more of a globalization, so a slowdown in the trend, in the pace of globalization. And there will be huge differences across countries, across goods. Digitalization will actually increase globalization, but then in some other ways, some of the more strategic assets will actually be produced inwards, domestically. And that, from my point of view, means really a more fractured world, a more diverse investment set, because there will be diverging trends around the globe, but it also means inflation. And that's a big challenge for the future.
Yeah, well, so on this question, I don't think that globalization is going to end, right? So it is very clear that the global model has been severely challenged over the last few years, ever since 2008, with the financial crisis, right? We saw that we had to redesign the architecture in terms of financial markets, right? With the pandemic and the war in Ukraine, we're seeing that having supply chains very far from you is not a great idea, right? So we also see that in some cases it has brought a lot of inequality, right? But I do believe that there are some common goals at the moment that we really need to take into account on a global basis. And I think that, for example, the Paris Agreement in terms of climate change is a goal that we need to do as a global, in global terms, right? So I think that the global model will change. It will become a bit more regional. Nearshoring is a really good opportunity, but I don't think that basically globalization will end. No?
Okay, thank you. Chris, your opinion?
I think the short answer is no as well. I mean, there's no doubt that globalization is under pressure. I think the spheres of influence will change over time as well, from the US to China Europe, maybe India in the future. If you look at our, 25% of trade is at risk from the relationship, the frostier relationship between China and the US as well. And it does feel at times that we're sort of just a misstep from catastrophe, whether it's a maneuver in the South China Seas, whether it's another kind of weather balloon coming over. But I would take comfort in the fact that, global trade has only just retreated from its highs in 2008. Globalization is often driven by practicality as well as ideals as well. The kind of the abundance or otherwise of those kind of factors of production. So I think, as demographic change happens, perhaps transition to renewable energy, that will start to kind of, reinvigorate some kind of trade patterns as well. So I'm positive about the future, and perhaps one day China and the US won't be such a big issue as it is today. Hopefully that will reside.
Yeah, hopefully.
So I hope the answer is no, because when you look at the past, the trade wars or even protectionism wasn't something which had good results in the long run. But I believe also that we have an end of some kind of carefree globalization. I would call it like that. That's 10 years ago, it didn't play a significant role. Where do I have my suppliers, and what are the different risks connected with a particular places, locations, partners, etc. And the events which took place in the last actually 3-4 years. So it was already mentioned. So first pandemic and its consequences, then war in Ukraine and its consequences, and growing tension between US and China. So for all these factors, I believe will result in the end of carefree globalization, but globalization as a term, I hope it still, let's say, work.
Okay, so, yeah, sure.
I just think that if you do have less globalization, I think Poland is very well positioned to take advantage of investment which could have gone to China, could come here.
Thank you very much. I just wanted to say the same thing. And we are also very well positioned in terms of AI, because we have very skilled labor force in ICT industry. So, but I understand that we have mixed feelings on that. Some of you are more optimistic. I'm a little bit skeptical. I believe that from the security perspective, in this more advanced industry, we'll clearly see nearshoring in many industries, but also technology, so automation and AI. Will make some of more advanced country competitive again from the cost perspective. Okay, so the third question, the last general question to all the speakers is on the general macro trend in this decade. Yeah, we are after 3 years of huge turbulences, so pandemic, energy crisis, war in Ukraine, inflation, so there is a lot of imbalances in the economy. We have not very good demographics in developed markets, very good demographics in India or Africa, not necessarily China. But what does it mean for the general macro trend? Do you believe that we are heading secular stagnation, as some US economists is predicting for some time? There will be fragile growth for the next few years, some recessions, very weak growth, or taking into account these technological changes and some stabilization in macro parameters, we are heading into next phase of rapid development. What's your scenario?
So, I'm an equity person, so I'm naturally hoping for growth. And I mean, if you look out and you look at what, I mean, again, I go back to the US and what the US is doing on climate, on clean technologies. I mean, they're going to deploy probably $1 trillion in their economy, and it's already started. So you're going to get, as long as the Fed gets inflation under control, stabilizes, things for people to plan, then I think that you're looking at a US economy which is going to do fine. But it's going to be in certain sectors. It's going to be in IT, it's going to be in industrials, it's going to be in materials. It might not necessarily be in the consumer sector. So you're going to have to be very choosy as to what you invest in. Selective, yes.
And Europe?
Well, you need a lot of reform.
Okay, you said everything.
But I think Poland's all right, but some of the others, I mean, they need a bit of a boost, if you like, in terms of their political and the way they've organized themselves. It's overregulated, basically. So it's hard for people to do business. Yeah.
I think it's going to vary. That's the answer. So divergence is going to be the theme of the future. But if we look at the past 15 years, we're certainly not going back there. So inflation is going to be higher, rates are going to be higher, and growth will be more volatile. That's the reality. So this is a much more challenging environment, and we'll need to play, when investing, those diverging trends. And so if we think about this year, for example, and if we think about the world last year and this year becoming very coordinated, everything falls at the same time, everyone is plagued by the same factors, but then there are countries like China, which are on a completely different trajectory, other emerging markets as well, that are sources of diversification and stability. So we'll see more of that, I think, in the future.
Well, I really think that that's a very difficult question to answer, right? Who knows what's going to happen in the next 10 years, right? But looking at what we're seeing at the moment, I think that while inflation is gradually being put under control, we don't know if they are going to get to the target level that they have announced, right? Because there are a lot of changes, right, in as you were mentioning, with China and so on, that would grant maybe a higher level of inflation, but it's difficult to know. What is clear is that for now we currently see that there will be a slowdown, right, in the economies, but we see that the economy, in particular the American one, has been extremely resilient, right? So it really depends how all these trends that we have been talking about unfold, right? But I see that there's a lot of investment coming up in different sectors, right? So the energy sector, the AI sector, and so on, that could boost basically a lot of productivity and growth in the economies in the future, right?
Thank you, Chris.
I think arguably central banks have, in a way, sort of dragged us out a bit of a secular stagnation in their response to the pandemic. There was hope at the beginning of the opening up that we might return to the roaring 20s, the 1920s, after all this pent-up demand would come back, and that was quickly replaced by concerns, of inflation kind of roaring in. Inflation is still going to stay high, but we think it will fall back a little bit kind of in next year. So globally, probably about 9% this year. 9% last year, maybe falling down to 7% or so this year. And some of those cost push factors, food prices still going to remain high. Oil is going to remain high. Perhaps things like wages in these more difficult economic conditions may start to fall as firms move a little bit from concerns around retention. And again, this will vary by sector very much, but to concerns about having to cut staff as well. So we might see some kind of less pressure there. But I think we'll return to a period of more sort of normalization. So pretty modest kind of growth rates. Inflation will come down a bit. We'll still have positive interest rates, but they'll come after a year or two. They might start to come down as well. So a period of moderation after this period of inflation.
Okay, thank you. Zbyszek?
So first I would say that making forecasts for 10 years is always risky. First. Second, I recall an interview with one of my favorite investors, Warren Buffett. He started in 1942 several months after Japan attacked United States. In Europe, the war lasted at that time for 2 years, and there were huge tensions uncomparable to those we have now. And when we look at the last 70 years, the economy and societies have experienced a wonderful, extraordinary growth. And that's I think we should remember about that. Coming back to the next decade, to answer shortly, I would say volatile but still growth, and unfortunately higher inflation. So all these investments which are needed, plus all those tensions we have to face, will make keeping inflation at this level we had in the last 2-3 decades. It will be much more difficult.
Okay, so thank you very much. So I understand that the Goldilocks economy is over. We are now in more turbulent decade, but you expect some stabilization, at least in the next 2-3 years, that we could come back to some more balanced economy, especially in terms of inflation, but generally high inflation. So it means, and there is a question to Esther, that once the era of cheap money has ended, and we don't see now zero interest rate policy anymore, where do you see that there is a next equilibrium levels for interest rates?
Okay.
In the core markets, where do you see the terminal rate in US and then in Eurozone, and what does it mean from equity and bond perspective?
So when I started my career, I started as an economist, a junior economist, and my boss told me the rule of thumb for 10-year rates is GDP plus inflation, real GDP plus inflation, the trend. So you say, well, what's the trend? 2.5% for GDP, 2% for inflation. You're talking about 4.5% to 5% on a 10-year being roughly where, rates should be in the US, maybe a bit lower in Europe. So that's what my equilibrium would be. So you're saying, well, the Fed's maybe nearly finished, so then the yield curve needs to tilt up. And then people can start to go about their daily business again, in a sense. But if I look at equities, I look at, say, the IT sector, they're loaded up with cash. They can make money just by leaving it on deposit in the treasury market, whereas other sectors are very highly indebted, so you want to avoid those. But you can't say, oh, well, but maybe, I don't know. Can you say you buy an index? You might get some sort of average return, but if you are selective, you can probably still make a lot of money going forwards because of this transformation we're going to get in the global economy, in the, the electrification, in all these huge drivers. Yeah.
So productivity.
Yeah, because if you look at the Department of Energy, they're in charge of the lending, and Congress has given them a huge leeway to lend, huge, and you can just see it. In fact, I would say everybody should sign up to the Department of Energy's newsletters, and you will see how much is going on, including in quantum computing, everything.
All right. So I understand that we are just now on the peak of interest rate cycle, in your opinion?
We're nearly finished. I don't think they want to kill everything off.
Yeah, next year.
They want to get some order into the proceedings, right? Ultra loose money doesn't help anyone, and you need some discipline. You really do. And okay, we had exceptional circumstances, but if we're going back to normal, we've got to get interest rates back to normal. But I don't know what you think normal is in Europe. Can they cope?
I think normal is certainly a lot higher than it was, than it has been in the past 15 years. So I would say rates are not going back to where they were. In the US, we've had a much more variable monetary policy, much more geared towards the cycle, whereby you hike rates when economic growth is very high, but then you have that flexibility to cut them when economic growth falls. In the Eurozone, we haven't had that. The ECB was one of the few central banks that actually could not cut rates during the pandemic, because what good could you do? They're at minus 0.5%, going even more negative. It's going to kill the banks. So we're not going back there. I think the ECB learned from their mistakes, and they realized that they need that flexibility to be able to fight that more volatile growth that we talk about. So if growth is going to vary a lot more, you need monetary policy to be able to accompany that.
And Simona, question to you regarding this. So we have global tightening. Yeah. You mentioned that maybe to some extent QE or the zero interest rate policy could be perceived as a policy error, especially that banks move relatively late, taking the pickup in the inflation. But what does it mean from the investment perspective? How to construct the portfolio these days? Whether do you see some asset classes that could be attractive? And what does it mean from the valuation perspective?
Yeah.
Whether we could face some new crisis coming from the valuation of bonds in banks, which we already observe in US or in Switzerland, or property market could be another, unfortunately, source of risk. What's your view?
So I would say that portfolios will need to be built very differently from what we have become accustomed over the past 10 to 15 years. So what worked in an era where growth was low, but very, very stable, money was extremely cheap, leverage was very cheap, and inflation was really not something we had to factor in most portfolios. That's not going to work in the next 10 to 15 years. We talk about some of the themes of the future, right? So we talk about deteriorating demographics, we talk about decarbonization, we talk about deglobalization or globalization, whatever you want to call it, the trade war and the general fragmentation between the US and China. All of that is inflationary. And that means that if central banks are not willing to accept this higher inflation by changing their bank targets, they will need to correct it. And that means raising rates to a higher level than in the past. So negative rates, as I said, are probably gone. And to be fair, QE was not a mistake. It's just that you need to use it at the right time. You can't just have 15 years of QE and more QE and more QE, because that's not going to work at the margin. So if we think about the world we are heading towards, you need to think of three themes for portfolios. And the first one is, I think active management is going to work much better in the future. And that is really true because if we think about after the global financial crisis, I mean, you didn't really need active managers. Any beta strategy, any ETF would actually work. You just needed some beta, and that's it. There wasn't a lot of dispersion across returns. So that was the era of easy money. Now money is not going to be that easy. So active managers can make the difference. They can play across the dispersion. They can find the micro trends and can leverage the themes of the future. So that's the first thing. The second thing is you will need a combination of private and public assets. Going just public is not going to make it. Why? Because you have inflation. So remember, you didn't need to factor in inflation in portfolios. What you got nominally, it would basically be the same as real returns. But now, even if inflation, let's say in Europe, goes back to 2.5%, it's 2 percentage points more than it has averaged over the past 10 years. 2 percentage points less that you're going to get in your portfolio. So you need private assets to generate extra returns so that in terms of real returns, you're at the same level as before. So, you've got to have to work harder to make those returns. And that means private assets like infrastructure, for example, private credit, but also liquid alternatives that help in times of high volatility. And then the third thing that you need in a portfolio is to leverage the themes of the future. So we talk about decarbonization. You'll need to incorporate, a good chunk of ESG or green assets in your portfolio, not because it's the right thing to do, but because that's what's going to drive returns really in the future. And if you think about demographics, what sectors are going to benefit from declining demographics? Well, healthcare is one of those, because we're all going to get older and we're going to need a lot of care to be looked after. And so healthcare will be a key beneficiary. And then, of course, we talk about deglobalization, and so cybersecurity and all those sectors that will be domestically produced, will be in demand. And then AI, digitalization, that's a big thing of the future. Tech is the future. And so trying to anticipate those trends will be key in a portfolio. Now, going back to the valuation point of view, at the moment, we are at the end of an economic cycle. I was laughing a few months ago when I read an article saying, maybe there won't be any lending. I was like, oh, is that even possible? If you don't lend, you crash. So it's not something that you really want. At some point, we're going to lend. And so how does the lending happen? Well, things break along the way. We had the banking crisis earlier in March, and we're now having this crisis in commercial real estate. That's how economic slowdowns happen. But if we think about the longer term, and if we think about where we are in a cycle, it's normal that valuations will have to correct in certain sectors. In some others, like tech, we already had that correction last year, right? Huge correction. And you see that it's now bounced back. Maybe a little excessive, but still, still possible. But valuations in some sectors will need to correct. And most of all, we are out of the year of cheap money. And so those businesses that were used to using a lot of leverage to turn around big returns will no longer function in the future. It's all going to be about micro factors and the quality of the managers.
Okay, thank you. And Jose, a little bit similar question, but more about the industry trends. Because in the asset management industry, we see huge consolidation. We see generally the consolidation in terms of capital flow, especially with higher interest rate in core markets, the capital flight to US, to Eurozone from emerging markets. It makes more difficult for smaller countries, smaller companies, or smaller funds to raise money. How do you see the future of this asset management industry in terms of in terms of the consolidation? Whether this trend will continue, and what's your view on the private assets, private equity, venture capital, all these alternative asset classes, whether they should be important part of any asset portfolio?
2022 was a horrendous year for the asset management industry in general. Give or take, there's like 100 trillion of assets under management. Depending on the study that you see, but let's take that number. And basically, it fell around 10%, right? Because anywhere you mix it, equities fell, bonds fell, so basically the AUMs of the industry fell as a whole, right? Of that, I would say that around 15% is in private assets, right? But very importantly, like 50% of the fees come out from those private assets. So asset managers do have the incentive also to promote this type of underliers, right? I would say all the way from the financial crisis and then the Dodd-Frank Act, basically private markets have taken a very important role in financing a lot of innovation, a lot of smaller companies. So they are absolutely necessary for the economy to keep growing, right? We also, I would say, saw last year the challenges of 60-40 portfolios, right? and the need to increase diversification, and there's many ways in which you can do it. And one very good way of doing it is through private markets, right? So definitely I think that private markets play a role from a portfolio construction point of view. The challenging thing at the moment is that given where the level of interest rates are and credit spreads are, basically for a client to justify an investment in something that is so illiquid in some cases is going to be difficult, right? But definitely I think that there's a role for alternative investments. Aside from that, I do agree that we need to think about active management, right? And including everything that is going to bring diversification into your 60/40 portfolio. Well, we talked about all the different potential trends that could drive the market. We talked about AI, we talked about nearshoring and so on. And I think that selecting those topics is very important, right? I don't believe that basically this overall trend, either in rates or in equity markets, is going to hold for the next 5 to 10 years. So we have to be very selective, and that's where asset management value comes.
Thank you for that. And I believe that we have some interesting takeaway from the discussion that active management is coming back after the decade of low volatility, passive strategies, ETF. But maybe some follow-up question to you, but because in some areas it requires a little bit different competences. So do you believe that asset managers will have to invest more, I don't know, in sectoral expertise or be the competences for these alternative asset classes? Because it's a little bit different story, yeah?
Well, at our company, we used to be a very fundamental type of company, right? But we have changed in many regards. So, for example, one thing that we have done is to invest a lot in quantitative capacities, right? Capabilities. So I think that quantitative capabilities are going to be very important, and that's something that we have invested very heavily on. And in terms of offering, also one thing that we are doing is thematic type of investment, right? So trying to give you exposure not only to a growth story, but to a growth in a particular industry and so on, right? So I would say that the two big things where we are putting our bets from a Santander Asset Management point of view is in quant to complement the fundamental DNA that we have, and in thematic type of strategies.
Okay, thank you. And coming to Chris, because you're a specialist in data, so we just heard that this quantitative analysis will be important, so it is strongly based on the data. How do you believe the AI will change this world of analysis of the data, financial media, content generation, and what could be the important investment topics in the next few years?
Yeah, and I think that kind of quantitative approach, I think, will become just much more important. But it's not new to the hedge fund industry, for example. I think hedge funds are probably a good way to look at what's happened in the recent past and what might happen going forward. So hedge funds have been using quantitative techniques, probably for about 20 years or so. Kind of 2 Sigma, AQR Capital, amongst others. And
long-term capital management.
Yeah. Yes, that's true. That's true. True. Exactly. So and the quants have performed on the whole pretty well over that period. When you look at returns from quant funds, for most of that period they probably outperformed kind of traditional funds. But that it has taken a long time for hedge funds to adopt AI. There have been some blips. So in 2019, kind of retail investors piled back in when their commissions went down to 0%. And quants didn't do so well for that year, and then they kind of reverted back in 2022. So I think that's going to be the story for AI. I think AI is going to have an impact, particularly on supporting kind of trading strategies, the kind of quantitative work that can be done at scale with AI, I think is going to open up fantastic opportunities. But I think it will take time. Regulation will kind of have to kind of catch up. We talk about kind of the need for humans in this relationship, and I think as the demographic shift happens and the wealth transfer happens, there'll be many more people, keen to adopt kind of AI services. I think there's quite a lot of technical debt in financial services as well, so AI needs to run on good infrastructure and good data. And as a publisher, that's something that we care about a lot. So,
but I heard that already in Reuters and Bloomberg, a lot of notes are generated by AI. I don't know whether it is really the true, but what do you believe it means from the research perspective?
Yeah, I think for journalists, I think for many analyst-based roles, I think generative AI is going to support in a big way, and that probably means we need less analysts, but better quality analysts that can utilize AI as a tool, I think.
Esther, want to add something?
Well, I was going to say, I use transcripts all the time, and I can see that now they're produced by a machine, and they're full of mistakes. So it needs a long way, there's a long way to go. And by the way, I am an active manager. We do have it at State Street. We're not just index.
All right. And on the interesting topics?
Yeah, we're a big fan
for investment.
Yeah, I think we're a big fan of emerging markets, and I think when you look at kind of areas of growth, Asia is one kind of area. So I think particularly kind of Southeast Asia, as production kind of reroutes a bit from China to there, that might be a hot spot. We picked up on kind of healthcare and demographics that has to stay there. Tech, AI could be kind of another kind of bow in a string in the bow of tech going forward. So that might help to kind of drive that. But when you look through the pandemic, energy companies have probably been the best performer. That might continue a bit, perhaps, in a kind of a high interest rate world. But yeah, I think lots of areas, electric vehicles, as in China quite recently, they've met their target well before. They plan to, I think, there's lots of interesting areas to think about.
Okay, and Zbyszek, what does it mean from the investment product perspective and then distribution? Because in the last 2 years, actually, because of higher inflation, many people in core markets, but also in emerging markets, taken a huge haircut on savings, unfortunately. So the real returns were negative. What does it mean from the preferences of the clients, and whether do you also believe that sale of investment products for retail could move more and more into online channels?
So I do represent this distribution side of our business. So I work with clients that are distribution partners. So first remark would be that this inflation was some kind of a shock for clients. In developed markets, very few people remember time when this inflation was at the double-digit level. In Poland, it's a bit easier because we had it 25 years ago, but still this outbreak of inflation was a surprise. And I recall the messages or statements of many central banks, including the Polish central banks, that the messages were in the last 3 or 4 years were like, we have a problem with deflation. We won't have a problem with inflation. We have a temporary problem with inflation, and now in Houston we have a problem. When I look at the simple strategy that you just unfortunately many Polish clients do or have done for a long time. So a mixture of bank deposits and short duration debt probably will not work as good as is in the past. When I And maybe the key challenge for us is to, means locally, to persuade people, to our clients, to transfer at least part of their assets to those asset classes which in the long run generate better rates than inflation. And based on the, let's say, last 100 years experience, those are equities and properties somehow. So here, I would say that on the Polish market, we have a great job to do to persuade to shift this. So for the time being, it's more than 50% of assets in Polish investment funds is located in short debt funds. So first is to encourage people to transfer part of those assets to mix or equity funds, and second, to help them to understand that investing is a long-term process. A very frequent question I get from clients is, what would perform, so the question which Pavel asked you as portfolio managers, what will perform best in the next 12 months or 2 years? And I believe that it's not the most important question that clients should ask, and not the most important question we should answer them. So the crucial point is to persuade them to think a bit different, and especially in the long-term perspective about the investment. And one short remark about online channels. Actually all products and goods move in this direction, and financial markets is an exception, of course. Some simple products like cash accounts, credit cards, bank deposits, or cash transfer, they have been already digitalized. In case of investments, I think we are not at that point. So still, many of our clients expect that they will be, let's say, they will have a direct contact with, and this human factor is still important. But again, so this generation will change, and maybe for me this contact is still important, but for those who are now 30, 35, and they step by step are getting richer, older, and they start to think how to invest their money, so they feel, I believe that, I assume that they will be much more open to do it online, and much more open to get knowledge about investments online. So this trend, maybe with some delay, but will also exist or appear in this investment fund business.
Yeah, in banking, almost nobody is making deposits in the branch. Yeah? So,
but
sooner or later, maybe we will see it also in terms of the investment products. So we are just about to finish our panel, but maybe there is some question from the audience to our speakers. If not, because we are we have reached the time limit. So thank you very much for our speakers. Thank you very much for the participation in the panel.